everyone, and welcome to our weekly educational webinar. My colleague Sai Mahesh and I would like to thank you for joining. So our topic today is about the most recognized and popular oscillators. So we'll start first with having a quick understanding of what are oscillators. So they are technical analysis indicators that change with price fluctuations within specified limits or levels. Usually traders, they use these oscillators to have more understanding whether a trading instrument is overbought or oversold. So for example, I apply this oscillator on, let's say I'm interested in euro dollar or pound dollar or gold, Dow Jones, any stock. So you can apply it on any type of financial instrument. So you just apply this oscillator in order to check whether the market is overbought or oversold relatively to depending on the recent price action or previous prices. So oscillators can be used by those looking for breakouts and reversal trades also. So it doesn't matter if you trade the reversion back to the mean or to breakouts, you can use oscillators, yet they are most beneficial when the price is trading sideways. So when the market is trading sideways, they give better acknowledgement on the market. This would satisfy you with some reversal trades. So now, after having a quick insight into oscillators and what are oscillators in general, let's move in precise to the relative strength index, or the RSI. So usually RSI is one of the most popular technical analysis indicators. The RSI measures the strength of the current price relative to previous prices decided by the period used for calculation. So for example, when you use RSI, or when you want to apply RSI on a certain chart, you just need, what you have to do only is just set the period that you have to apply this study on. For example, I have to, by default, it is for the 14 period. So by default, when you drag the indicator to the chart, usually it calculates the strength of the price relative to the past 14 previous prices. So this is for the RSI. Traders can use usually RSI as a filter for trades. So they can use it for a bias and as a signal generator. RSI also can give us traders some more insight for reversals by showing the divergence between the price and the RSI. I'll be talking about this also in the coming minutes. So the RSI first, let's see how the RSI is on the chart. So this is a euro dollar chart using the 1 hour time frame, and this is below the relative strength index with the period 14. You can see the period here. So it is showing the strength of the price relative to the previous 14 periods at every period. So these are the arrows showing. We have on this chart, we have two key levels shown here, the 30 and the 70. You can adjust these levels based on your appetite, based on your risk appetite. So you can set, for example, you consider the price above 70, it is overbought, and below 30 it is oversold. Or you can take this level to 80. You can also drop the level of the oversold signal to 20. So it depends on your understandings and your risk appetite. You can choose the levels that you want. Maybe some higher levels, they are more conservative, and some lower levels, they are they would generate more trades, maybe could lead to higher defects or more defects. So it depends on your trading and your trading experience to choose the certain levels. Some people do choose 80 and 20, others they keep it as is, 70 and 30. The 50 line is the neutral line, so some traders use the 50 line for bias. As long as the RSI is trading above the 50 line, this is positive for the price. As long as it is trading below the 50 level, it is negative for the price. Also, they can use the 50 line for entering some trades to trade the move of the indicator between 50 and 70 and between 50 and 30. Also, some traders who look for breakout, they believe that after a break of the 70, the momentum will be higher and the market will move higher faster. So they look for buy trades at the 70. That's why I mentioned at the beginning that the RSI suits two types of traders: those who are looking for breakouts and those who are looking for reversion to the mean. So here, on these examples, you can see that the RSI dropped below 20. So usually what do traders those who want to trade the reversion to the mean, they wait for the price for the RSI to go back above the 30 level, and then they enter a buy price. So here we saw the price rebounding back up. Also here the same, when the market went, when the RSI went down below 30, the RSI moved back above 30, and the market also had a move higher. Here when the also RSI was above 70, traders will wait for the RSI to drop below 70 again and sell. So here also the market reacted lower or moved lower. Also here we had like two tops in the RSI. The first one had a small movement, and the other one was the key reversal. So that's why we mentioned earlier that the RSI usually is best when the market is moving in trading sideways. Is trading sideways if you are looking for reversals. But if the market is trending, usually you'll see a cloud for the RSI, clouding above the overbought level, or clouding, or having also another formation like this one here below the oversold level. So here also traders would wait for the RSI to go back above 30 to buy. The market moved a little bit higher, but also here there was a little bit of a trending move. So it wasn't a perfect signal. This one was a good signal, also a small scalping. The market, when the RSI moved back above the 30 level, we witnessed some move higher. Also this one was very recent, so when the market moved back below 70 level, the market dropped almost around 20 pips. So this is for those who are looking for trades for reversion to the mean. So when the market is moving away from its mean, they are looking for trading back towards the mean. They can use the overbought and oversold levels in order to initiate their trading signals, their buy or sell trading signals. On the other hand, there are the different types of traders that will look for different signals when the market is trending. So for example, let's say this was a short trending move, the traders will look to sell at the 70 for a break lower, or a move breakout lower from a certain range, and vice versa. Traders will look to buy above 70 of the market if they believe that the market is breaking a certain resistance and is gonna move in a certain uptrend. So they would use the RSI for this entry. So here it's a small brief about what we just said. So the RSI buy signal, buy when the RSI crosses above the oversold line, if you choose the oversold line or oversold level as 30. So this is a trade for reversion to the mean. And those who are looking for breakouts, they can buy when the RSI crosses above 50, because they consider the 50 as the neutral line. So if it trades above 50, it's a little bit positive, or a break above or a cross above the 70 level, and vice versa. For the sell signal, sellers will enter in a trade when the RSI crosses below the overbought line again. So the market moves above the overbought line and then moves lower. When it is moving lower, they will sell the market for a move back to the mean. And those who are looking for breakouts, they will sell when the RSI crosses below the 50 line or below the 30 line, the oversold level that they choose. So this is for the direct signals for the RSI. We're going to talk about the divergence, which is something really interesting, and it gives like we have less signals than divergence, but they are usually more accurate. So what is the divergence? It is usually when we have a higher low, and for example, if those who are looking for a buy trade, they look for a higher low in the RSI but lower low in the price. So here you can see that the RSI had a higher low. It was trading here and then moved higher, but the price continued to move lower. So this is a divergence, and the market moved up when we broke above this resistance. The market continued to move higher. So this was a clear signal for a reversal in trend. The market was moving lower. We had this divergence between the RSI and the price. The price continued to move a little bit lower. The RSI moved higher and the market reversed. Also here we have this small divergence. We have triple divergence here. So we have this first divergence between these two tops, and the market moved a little bit down. Also we have divergence between these two tops, and also the market moved downward. There is also a bigger divergence between this top and this top. So we have here a higher price, but you can look at the RSI here. It was around the 80 level, but here it just went a little bit up the 70 level. So also we have a bigger scale divergence here on these two tops, and the market moved lower. Also here we have a couple of divergences, so the price continued to move lower, but the RSI was moving higher, and on the first reversal, on the first bullish engulfing signal, the market moved to the upside. Also here we have divergence between these two tops, so the RSI was higher than here, so we have here a lower high, but the price had a higher high and the market moved a little bit lower. This is for the Canadian dollar on the hourly chart. So this is in brief the RSI, all what you need to know about the RSI. We'll go to the MetaTrader 4 platform in order to show you how to plot the RSI and to make use of it. So let's just let me remove this. So here, for example, for the pound, you just go for the navigator. You can find here the RSI, or under oscillators also you can find it here, relative strength index. So you just drag it to the to the chart. Here you can choose the period. You can choose whether to apply it to the close, open, high, low. So you can choose your preferred price to apply it to. You set your visual, and then for the levels here you can put the 30 level. You can just click on it. You can go for 20 for example, or 80. So you just set the level that you want, and you press OK. So here we have the RSI for the past 14 periods, showing showing the RSI, or the RSI calculation for the past 14 periods. So let's just have a little bit of a demonstration here. So when the market moved, when the RSI moved below 30 level here, the market was moving lower, and then when it bounced back up, so there was a buy trade here, and the market moved higher of the minimum of almost 70 pips at the first H4 or the second H4 candle. Also here, when the market moved towards the 70 level and moved back lower, it was the top. So here we got a sell signal. Also the market moved lower. Also here we had the market was moving higher, so we got some pips higher, and we got another signal here. There's a divergence. If you can see, the price moved lower, so we had the lower low in price but a higher high in the RSI, and the market moved up around from 23.55 almost to 24.60. So this is 100 pips move for a small divergence signal in the RSI. Some people do also prefer to have a shorter period. I'm going to demonstrate the RSI with the shorter period. For example, let's say this is the period 6, and we go for tougher levels for 20 and 80. So this will have much more of a moves. Usually some traders do shorten the period for the RSI and look for breakout trades rather than reversal trades. So just like this one here, they would start selling here. So they sold here and the market moved lower. Also here some trades, so grabbing some pips if you are looking for breakout trading. So it depends on your interest, whether you are looking for reversion to the mean trades or breakout trades. You can set your period in the RSI. You can set your limits also for the RSI. So this is clear. Maybe if you want, we can go for another one. Also here, this is for the dollar yen, the H4 chart. Here you can see also there was a divergence in the price and the RSI. The price moved lower, there was a divergence here, and the market moved back up. Here, when the market bottomed near the 30 level, also we saw a rally higher. And here, when the market when the RSI went back lower than the 70 level, the market also moved lower on the dollar yen. So this is for the dollar yen. Also by using analysis by using the relative strength index. So this is a good tool if you want to trade. Also, you can plot the 50 level for those who prefer to check the bias. Also, they can add the 50 level here. So also they could use the 50 level as a filter. So if they have like any other indicator used for signals, so they can get their signal from the other indicator, and they would enter a buy trade if the RSI is above 50 and their other indicator gave them a buy signal, and vice versa. So if the RSI is below 50 and their indicator gave them a sell signal, they will also enter a trade. So this acts as a filtration, the 50 level, which is the neutral level for the RSI. So this is all you need to know about the RSI. My friends, my colleagues, I will be talking about the stochastic oscillator, which is also a very good tool for traders. Sai?
Yeah, thank you, Wael. Hello, everyone. This is Sai joining with you. Hope we're going to look into the next oscillator, which is one of the best popular oscillator, which is a stochastic oscillator. If in a simple term we say stochastic oscillator, the concept is very easy to understand as like RSI. These two oscillators are like twins, like you can always be go along with the easy to understand to give the entry and exit. So basically, this stochastic oscillator, was developed in the late 1950s by George Lane. It is a momentum indicator. Basically, it's a particularly the closing price of any instrument in the range of the price for certain time periods. So this generate the even both in case of RSI or maybe oscillators, stochastic oscillators, both as give the two type of range. That means like a range between from 0 to 100 bond range of values, which is like we've seen RSI shows like 30% and 70%. Same way, this oscillator gives you the range of generally in the range of like 80% and 20%. So if we say 20%, which is almost called a oversold place, and you're talking about 80%, which is always overbought. That means the pressure of the selling pressure has been will be less down when you're reaching the 20% below. Whenever the reaching the above 30%, the overbought level, we can see the pressure of the buying pressure will be slowed down. So from you can easily understand that like it's a very easy way to identify. Okay, these are the place where the markets are more chance to correct back from the bottom or from the higher level of the correction side. So when you say there are two important factors are involved in the stochastics oscillators, that's mean like the calculations inside the inbuilt calculations, which are proven the oscillators. So it's nothing to be calculate manually to understand it, but we can keep the tracking of two factors. One we can say is a K factor, one is called D factors. So these two are the main factors which are going to drive the oscillators to give the entry and signals on wherever the closing of different time periods. So when we say the K factor, which is nothing but the close and low, which is divided by I and low of the particular time into 100. When you're talking about the D factor, with nothing but the simple moving average of the K factor, usually it comes at 3-period moving average sensations. So the concept here is very, very simple to understand. Once you have understand actual concept about how to read the stochastics oscillator, so easy to understand both the signal, like you can say buy side or we can say sell side. So when he's talking about the buy side signals, when the stochastic is below the oversold line and the K line is crossing above the D line, which is called buy signal. That means there are two parallel lines which is going to be, that's one is a K factor, one is a D factor line, right? So whenever there is a diversion happened, when there is a lower side 20%, that means there is an oversold level happens. So that's a signal for you for the buy side. Similar to that, so vice versa, whenever the stochastics are seen above 80%, which is an overbought line, and there is a K factor line and crossing the below the D factor line, which is a sell indications. Very simple. It's a very simple to understand. But before you get into the live markets, always make sure that you have thoroughly read about what exactly the factors about, and to enter a live demonstration, always be a practice all the time. So let's have a small screenshot here to look how exactly the oscillators will be keep moving. We are going to see the live demonstrations of a couple of examples on the live markets today. So here we can see there are arrows are mentioned here, right? So these are the indicators, which is sold levels. The market has given an indication for the selling pressure, and you can see two of the arrows in the bottom, which shows an indication for the buying trends. So this oscillator, where you can see the two parallel line, I mean, you can two above line and the below line. So some traders usually keep 80% as their entry level, entry point to come to give the entry convention and divergence on that point. Sometimes some traders will keep it below 70 level, 70%, like 30 and 70 as like RSI. By default, many of the most of the traders will keep 80 as a 20. So here, what happens here? We can see a signal sign here. So this plays where the K factor and the D factor has been crossover, and you can see exactly there is a movement happened here. So this example we've shown it for euro USD dollar. It's a very recent time of markets move. So this is a short trend we can see where we can go for a sell indication, and whenever you see a downfall, we can always make a downfall trend where you can make a profits. Same way, when you see a downside, there is a below 20%, we can see a signal happens here, and exactly there was a buy bullish trend has happened here. See, this all depend on the time frame. Which time frame do you use? Basically, when you take in a shorter time frame like 15 minutes, this stochastics works in all different time frames. It doesn't mean like it's only look for longer or shorter. It works with all the time frame. We can see 15 minutes or 30 minutes or 1 hour. So depending on the width of the markets or depending on the movement of the market, it gives the profits. For example, you take 15 minutes, you can't expect in currencies we can see 10 to 15 pips or something like that. In case of 30 minutes or 1 hour, we can expect more pips like 10, 50 more pips. When you're talking about the 4 hours or 8 hour or daily charts, it gives a higher level of range, but the risk factor has been calculated according to the level of your profit range. So you can see there is a buy signals here. So where there's a big move happen here, and you book the profits here. Even if you want to continue the profits, and you have to be maintain your risk management, the stop loss level or the trailing stop loss to be maintained along with that. And again, there is one more entry came here again exactly above the 80% of the range. You can see sell a clean sell, which is really a very good entry level to be on a seller side, and this was continue for a while, come to this levels, and there is no any big see as I said. So even while was saying about some traders look into 50% above this range also sometimes, because we don't always expect the range on a higher level, but as not much risk traders always look into the higher level, higher range of like 80% or 20%. Sometimes we may get a chance in between like 30 or 50 or 60, something like that, but it's depend on the risk factors, how much you take, how risk you're going to enter into the market with. It depends on the stop loss. So again, we can see a small sell indications happen, and there was a correction happen in the market from the top, and there is a sell off is happens, and again there was a small buying indications happen, but I don't think so it has been given in the buy trend. But still, if you're entering the market, but still you'll be keep on holding it, because there is no any type of selling indication has been not been arrived, or maybe not touched the 80% of the markets of stochastics. So as like as like all the oscillators and indicators, there are the pros and cons are there in this oscillator. That in case of pawns, like you can say clear and exit signals are there. When you come to the cons, maybe false signals can occur due to the market trend. One side, the markets keep trading on one side, where you're going to see the next slide about the divergence, the stochastic divergence, how exactly this will be conceptually works on this. And this signals frequently comes. For example, you take for 30 minutes, 15 minutes, every 1 hour, 2 hours, or 3 hours, you can see frequently you can see the signals. But make sure that you follow the signals consistently along with the trend. Sometimes there are false signals, but in fact, like you have to be in the trend. And coming to the cons, like we can say there are, as I said, like this one side trend will be continued, then there will be a failure happen because the market is overbought one side or maybe oversold one side, where we can't be on opposite side directions, since you have to be a breakout direction. As you said, there are different traders are available. Like one is a correction market traders, where you can use 80% or 20%. Or if you break out, maybe we can see the markets on a one side direction, you'll be selling on a oversold level, and you'll be buying on a overbought level. So this two difference. And major easy concept, easy one to benefit out of this oscillator is very easy to understand and easy to available on any platform where we can able to get into it. So let's go to the oscillator divergence, where I was discussing about a major thing. Is a very interesting ones, because most of the oscillator traders you should be adapt to this in this type of concept, because we can't believe on only on two side. It can be on a one side direction of the move. I have marked here the two type of arrows here, one here and one is the other one at the top. So here what it says, like markets in an uptrend, so you'll always be on a buy side. But here it was a divergence happens here, since there was no other, even it shows the sell indication, but the market has been divergent years in the above the range of this. So you will be on a buy side direction completely. So this is like many traders use other moving average level period also along with a breakout level, which helps with the resistance and supports. So which gives a one side direction. By chance, if by mistakenly or maybe given any false signals on the over in this areas, maybe you are in sell side, definitely this can be taken only with the high risk traders, because you need to average and on three places, one year, one is a year, and one is the third part year. So maybe you get a correction of same level, maybe come out with a neutral, or maybe come with a small loss of whatever the risk management you have been maintaining on your trading. Same way, when there is a upper side, we can see a trend has happened here, and it is a one side directions. So again, this is exactly the divergence happens in the one side direction on the selling side, where you keep traveling on the one side, because I don't see anywhere the market is given any buy indication. Still the stochastic is trading below the 20%, but still it not giving any buy. Even just like giving a indication below 20% or above 80%, it doesn't mean that you have to enter the market suddenly. Wait for it, let the cross is 80% below, or let the cross 20% above, or maybe we can say proper closing on the chart. If you're maintaining the candlestick charts, let the close the charts, let the candlesticks close a particular time. For example, half an hour charts, 30-minute chart, let the 30 minutes close, or maybe 1 hour charts or 4 hour, whatever maybe, let the candle close. Then when you break that particular level of resistance or support, then initiate trades along with your stop loss. So this exactly like shows you the divergence, where we can see one side directions where we can going to travel on a one side markets. So let's see, like with this two information, let's I'll show you some couple of examples on a MT4 platform. So where I'm going to give you a recent latest information for you. Let's take a Euro USD in 4-hour chart. Why I taken for the chart? Because if I explaining with the minimum time period, there are a lot of frequent indications are available. It may get confused, because since it's a base to give introduction about some oscillation information about the oscillators. So I want to get you a wider range of the chart, so you can understand how exactly to read it properly, so they can try to implement. So to plot these things, like there are the parameters available. As I said, there are two important factors are there. One is the K factors and one is D factors. So K is by default set as 5 or 3. As a beginners, don't change any fact or don't change any numbers into it, because it's like you need a more experience to understand what exactly the K factors are, how to read, how wider the range of the chart going to be, crossovers or something. So same way, like a field, price field, we can keep as a high and low, or we can see close. Always by default is a high and low. And as well as like moving average method, we can keep a simple or exponential. But I suggest you as a beginners, we can always keep a simple one, and just follow whatever the default parameter has been set in the on the indicator oscillator. Just keep on and just apply on it. So once you give apply, you can see excellent. The bottom side, you can see a proper graphical indication was been mentioned. Even if you want to be clear, see all the indicators oscillator to be very clear to notify. You always keep a very good colors for that, to ease to understand it. So you can also click on the properties, or we can see. Let me check. I can change some colors if you want, or if you're visible, it's well and good. So you can see there is a 80% a line here, and there is a 20% range here, right? So it's a very good example where I can see right now in a 4-hour chart for a Euro USD. So let me have it. So here, let me take us. This is exactly the market is given the across of K and D factors of above 80%. So you can see the selling pressure has happened. I guess it is just a couple of days before. So you can see that a selling happened in this point, and exactly there was that indications given on the stochastics. So the clear fall on a one side direction, which also has the divergence, because I can't see anywhere a proper buying indications which is below 20%. Seems to be the trend is keep continuing it. It's a very good selling markets, which was shown very clearly on stochastics, and especially like there was a small bounce back, and there is a crossover happening here. So maybe you can take a chance because you don't take a chance here or maybe here. Maybe you can take a chance here. There was a small corrections, which is almost like 30 to 40% correction of the downfall of the top from the top to the bottom. So same way, if we come over in this area, which is 20% again, we can see there is a bounce, there is a signal happen in this by bullish trend, where you can also give a good entry here, which has taken the market to the all the top here. So there was a very good rally trend on both the side, which is like a clear indication as given on stochastic. So which is really easy way, because that's why I've taken a wider range where you can understand in a proper way of how to read exactly the stochastic. So if you say the best combination of stochastic is RSI, as I said in the beginning, like the twin brothers, like always go travel along with stochastics, because some traders keep some other multiple tools along with this to have double confirmation, multiple confirmation, because it may not confuse other traders, but still they need a double confirmation on the trading, what exactly they take initiating the trade. Same way, like stochastic has a very good combination with the RSI, which also I can show you to plot the RSI, which try to compare this two indication, which entry on sell side and the buy side, which also gives you the direction on the same direction. Let's keep you the right. Yeah, perfect. So you can see here, like it's like the indication of 70%, 80%. Right, let me take the crossover. Right, you can see this. There's excellent entry as given on both in RSI as well as in stochastics. Even it is given a very good buy indication on this. So whenever there's a overbought happen, there is always a bounce, and especially on the longer time period, like 4 hours daily, or definitely there is a big move happens always. But don't hurry in the markets when you see the overbought or oversold. Wait, clearly wait for the candle, or what are the charts you follow. Maybe you follow the closing of line chart, or you're following about the candlestick charts of the closing. So clearly wait for the particular candlesticks to close or candle chart to close, then initiate the trades. So this helps you a long understanding about how exactly it is. So I hope you have got some good informations. Thank you so much.
Thank you, Sai, for your explanation. So if you have any questions, please write them down so we can have a discussion. Okay, Sai, someone is asking you how you did put the RSI and stochastic together. You just drag the RSI to
Yeah.
you just drag the RSI to the indicator, stochastic indicator window.
Yes, you can keep both combined, just drag it down the RSI to the stochastics, or drag the stochastics to the RSI. So it will overlap. So that gives you a very good question from him. Like it's a very good question, because it's when the both indicate oscillator on the same plot, on the same combination, and on the overlap, easy to understand the signals. It's clearly, it gives entry and exit of the signals.
Any more questions? Okay, there are a couple of questions. Okay, so first, how to see the entry and exit point when using both. Can you use crossover for those two as sign? So I'll answer the first and you take the second. Okay, so for the entry signal, maybe you can wait for the opening of a new bar and then execute your trade. So you just get the bias from the signal from the RSI or the oscillator, the stochastic oscillator, and then when the new candle opens, you can go for a trade.
So for question what you asked, like, can we use crossover for those two as a sign? Of course, like since I said like the both are oscillators, where you can also use a crossover to get the indications of the sign. So definitely it's best choice. This one is the best option we can do that. So since as you want to overlap on RSI and stochastics and combine the crossover, so if both are being crossover has been synchronized sign signal is there, definitely is a confirmed type of indications we can see there.
How do you know when to enter a trade with RSI? So it depends whether you are looking for a breakout trade or you are looking for a reversion to the mean trade. So this is for the RSI. I'm gonna do a small demonstration on the chart. So let's say we have this indicator here. Okay, so if I'm looking for a reversion to the mean, I'll just wait for the RSI to go back below 70, for the candle to start to close, for this candle, the occurring candle or the current candle to close, and then I will enter the trade. For example, here the RSI 70 was here almost, so it went back to 70 here. So I'll wait for the close of this H4 and then I'll enter a short here. Similar here for the reversal. Also, the market moved, the RSI moved back above 30, and I'll wait for the candle close, and the market moved here. So this is how you can enter a trade for the RSI if you're going for the reversion. If you are going for breakout trades, usually traders do wait for the price just to cross over, and then they will enter with the trade with the direction of the market.
Well, there's one more question for you. The
There
comment
are a
on you
couple of
longer length period of RSI example, like 21 period. You can see that.
Okay, so for example, for RSI, if you want to go for, if you want to have a huge, have look for a bigger period, you are smoothing more the signal. So whenever you go for a longer period, you won't get enough signals, or you won't get much signals as long as similar to having a shorter period like 8 or even 14. So maybe RSI won't go to higher levels. Usually this is used for longer term trades and not for short term trades. What's the best time frame for bigger for
Yeah,
entry
it's
and exit
frame.
RSI?
Yeah, what are the best time frame for bigger for entry and exit? Even talking about the both the oscillators, the best time frame we can say like a quite a longer. I'm not talking about the very short term. It can be 4 hours, which are very good time frame suit with both the oscillators. When you're going further for like going for 8 hours, or we can go for daily or weekly, and the patient need more. Like you get an entry cannot be frequently. But when you're coming to the lower right, like 1 hour, 30 minutes, 15 minutes, wider, like the frequency of the entries will be there. But a best frame of time frame for a longer time, 4 hours, I can suggest you in this.
So there's sometimes the RSI is yet to reach 70, but the price is going down. So this means that the movement relative to the period that you are using isn't strong enough to go for over both levels. So it's not always the case. So either if you are anxious to enter in a trade or excited to enter in a trade, you have to adjust maybe your period. If you are looking for, if you are following on some trading instruments that do trade sideways, so and the market is not going for the 70, you can look for adjustments of the period. But also you have to go for a bigger picture analysis to check whether you believe the market's going to stay in the consolidation zone, or the market's going to go for a certain breakout, to see whether the oscillator will suit you in your trading or not. Because we mentioned earlier that the oscillators, they are most beneficial when the market is moving sideways. So when you have this question answered, you can just start either adjusting your period or adjusting the levels of the RSI. So there's also a question for the hidden RSI, hidden divergences in RSI. Usually they happen when the prices make, for example, when the market is going reach a certain bottom and the market is moving higher. So for example, let's take this into consideration. We have the price would go higher, the price is higher, but the RSI would be lower. So this is also this is called a hidden divergence in the market. So the RSI would continue lower when the price moves higher. So this is uh, for the RSI if you are looking for signals from the bottom. On the opposite, if the market is moving is posting a lower high but the RSI is going for a higher high, also this is called a hidden divergence. So there is a question. Sometimes we have hidden divergence along with divergence. What should I do? Usually divergence, the shown the classic divergence is more of reversal entry, and the hidden is usually a continuation of a certain movement. So they are different. You have to look for other filters or for a break of a certain support and resistance to confirm that one of them, that either the classic or the hidden is in play. Okay, so it seems that that's it for today. Thank you all for joining. Sai, do you have any words to say?
I think there was one question has been coming out: red, the blue, or red
Oh,
line and stochastics. Yes, it's red, the blue, or the red line and stochastics. I guess so. What you're asking is like what the combination of the K and D factor. Let me show you. Let me draw for you stochastics so you can understand better. Yeah, you can see here. Like if you click on that particular blue line, you can see what exactly you can see here. Yes. So this is how exactly you can differentiate it actually. The signal and the main. So which is the K and D factors. So we can also like the main thing, like you can always keep dark lines, colors to identify this diversion, this crossovers, so which will help you like. So hope this can be like a range on the 5 and 6 by default. Wahal, someone asked range of zoom for indicator in chart.
range of zoom for indicator and chart. Okay, so this is for the RSI, for the stochastic we're using 533, and for the RSI we are using the 14 period on the H4 time frame, if this is your question. And there's a question, please, if you can type your question in English, that would be great.
You're welcome.
I guess there's a question in Thai, so if you can write it in English. Okay. How do you confirm divergence? Because sometimes you think there's a divergence, but the market will go against you. So usually for divergence, first for every trade you have to set a certain risk for it. So which could be the stop above the high if you're going for a divergence reversal to the downside. But also it is better to have some support if you are looking for shorts. It is better to have some confirmation for a break of a certain support, so you can have a confirmation of a move down. So normally divergence can be used either RSI, MACD, stochastic. What are the best divergence for monitoring? Sai, if you want to answer this question.
Yeah, sure. The normal divergence, normally we can use for either RSI, MACSO, or the best of the Divergence monitoring. Yes, of course, a combination of these three always, because as you know, the MACD is a range of support and resistance. So the divergence normally it's a breakout levels of buying and selling. So with support of RSI and stochastic actually commonly gives the direction one, but with adding with the combination of MACD, which shows a with the support resistance levels, the important resistance and support level, which helps you to monitor the divergence on the one side direction of the markets.
Thank you all for joining. Hope you had the proper understanding of these oscillators. If you have any questions, please do send them to our email webinar@icm.com or support@icm.com, and we'll be glad to support you. Thank you so much.